Hello and welcome to this special webinar from Fat Profits. I'm Roger Malik. I'm the Head of Client Services in our Sydney head office. Thank you for your company today. We hope to provide you some investor updates in the markets. And joining us in our studio today is our Senior Account Manager, Edward Allen. Edward, welcome to the webinar. How are you going?
Hello, Roger. Very good. Much better time in the markets compared to a month ago, where things were looking a bit gloomy, but yeah, pretty excited about joining our investors today.
Okay, excellent. Thanks for your time. And look, before we get into today's market information and some stock updates, a bit of usual housekeeping first. All our presentations from Fat Profits are general information only. We don't provide any personal advice during these sessions. If you're looking for that, please see your financial planner or advisor. And also past performance is no indicator of future performance. Now, during today's webinar, we encourage everyone to ask a question each if you like. If you've got a particular stock that you like us to provide some recommendations on, or the market in general, or if you have any questions about today's presentation, please ask the question and we will answer them towards the end of today's session. We've got a Q&A and we will cover that for you. So what are we looking at today? Firstly, we will look at the ASX 200, where we think the markets are heading. And we'll also look at three different sectors today. Firstly, we'll start off with the financials, hard commodities, that's big in play, and we'll provide our views, as well as soft commodities. We will also give a tour of our members' website, and we'll share our dividend portfolio, which has been producing 18% returns for the last 10 years. So we'll be sharing some insights there. I will also learn a bit more about Fat Profits, who we are. There is a special offer today as well for those who are interested in joining a high quality service. And then towards the end, we will provide 3 stocks to avoid in today's market, and also a hot buy towards the end. So stay tuned all the way till the end. We'll give away a buy recommendation as well. So first up, let's have a look at the market snapshot. Where we're at, firstly, starting with the S&P 500, the American index. So Edward, let's hear from you first. The markets in the US have had a pretty turbulent time over the last quarter, now that we've finished the first quarter of the year. What's our thoughts on the American markets first?
Look, we did start the year with a prediction of 15% correction in the US markets, the S&P 500, and also the NASDAQ, which has now played out. It's been quite volatile, which has been the benefit of some investors and some not. But for us as value investors, it creates buying opportunities. So we've done very well there. The good thing about here in Australia, we've got strong GDP growth, which is the envy of the world, versus record unemployment. So we believe at this stage we'll probably outperform the US this year.
Okay, so we're looking at the ASX 200 then. Yes, one of the things we did predict at the start of the year, you're right, Ed. We've been on record to say the market will drop by 15%, which they have. But with ASX 200, you're right. Look, we've got good GDP numbers, we've got good employment data, but also there's some other things we will look at shortly. But our view at Fat Profits is the first quarter is behind us. We've seen turbulence, we've seen volatility. Now in the second quarter, we'll probably still see some volatility around, because there is still the war, there is still interest rates rises, there is elections coming up in Australia as well. While in the second quarter, our view is we might see a little bit more volatility, but in the second half of this year, we're expecting the ASX to really shine and go past the previous all-time highs as well. And what are some of the reasons why we believe ASX 200 is prime? Well, here's the first reason. We are quite a big market for dividends versus some of the other markets in the world. And if you look at the chart on your screen, you will notice that in February 2020, on the ASX, we got $27.5 billion paid in dividends back to shareholders. February 2021, it was a little bit under $26 billion. But now in February 2022, which is just getting paid out in March and April, you can see that from 4th of March all the way till sort of end of April, we're expecting $36 billion to be paid in dividends alone, and the bulk of that has been paid in the week ending April 1st. And that's thanks largely to companies sitting on big cash holdings, and there's a lot of acquisitions taking place, and overall health of our ASX market is very strong. This next chart shows our market in the red, where you can see the red line, that's the ASX 200, versus the green line, which is Euro Index, and the blue line, which is the US S&P 500. So what does this mean? This shows the dividend yields on these markets, and we're well and truly ahead of the rest of the world. With the highest we've been, it's interesting to note, was in 2008, when our dividends were above 6% across board. And these are the good old days when Telstra used to pay 10% plus, but those days are behind us, unfortunately. But sorry, go back to the chart. But at the moment, we're above 4% in dividend yields versus the other markets. So we're slowly climbing back to that sort of 4.5%, 5% mark. And that's one reason to be bullish on the market. But another reason is iron ore prices. Now, Ed, iron ore has hit all-time highs in 2021. We know that. They hit over $200 a ton. But then we saw a big drop. And this is where a lot of investors were panicking and wondering if this is going to be doom and gloom and should they just get out of their positions. But we've been on record to say we expect iron ore to be somewhere between $130 to $150 a ton, and currently it is playing out that way. But your thoughts on iron ore and its importance to the Australian economy?
Absolutely, it's our key driver. It makes us the envy of the world. It's our number one export, I believe.
Yep.
You know, there are economies now with global warming. You know, I hear stories about, you know, cities building steel walls to keep the floods out. That's all going to require iron ore. But there's going to be some rampant growth post-COVID as economies start to stimulate their economies, and you know, iron ore is in strong demand. Now, just noted that we picked up Fortescue in that last quarter of last year as well, pretty close to the lows. So that's been a stellar performer for us as well. And you can see BHP there on the charts. You know, if we go way back, we put in buys on this stock back in 2017, under $20. I believe back in 2016 it was as low as got about lower than $15, I believe.
$15, yes.
So anyone that's picked up those stocks needs to understand that as value investors, you know, we're getting paid dividends on that initial purchase, not on current share price. So these dividends that our investors or our members are picking up at the moment are quite phenomenal. So you can see there on the charts, we took a sell half, pretty much on the top there at $41. You know, again, we waited for undervalued opportunities at $28, put in buys there. We had another short-term rally in 2020, and then the bottom came again at around 34, put more buys. So this is one that we definitely got right. There's quite a few like this that we've got it right over time. Because we've been researching this stock for over 20 years, we know this stock very well. So we know when to put the buys on it, and we also know when to put the sells. But if it's in our thematic, we're not going to sell at the top. If our thematic's long, we're not just going to take an opportunity to take a profit. We're going to follow our thematic, and that's how we get the timing right on these stocks. So Fortescue, again, as I mentioned earlier, we only first got into this stock in the last quarter of last year. Pretty close to the bottom, not quite, but anyone that followed our buys on that, well under $17, $18, $19, as low as $14, has made some substantial gains in the short term. And that's part of our thematic, a very good yield play, a stock that's moving into green energy. They've started a separate part of their business at Fortescue, led by Andrew Forrest. So that's a stock definitely that we'll be researching closely in the future.
Thank you, Ed. Yeah, so iron ore is strong. So that's another reason why we think ASX will remain pretty strong for the rest of this year. But oil prices is another one. We've got a number of producers on our ASX which are quite big. And look, this oil price has had a huge run. Edward, especially in the last couple of months with obviously Russia coming into play. But overall, your thoughts on the oil price and our play?
Yeah, absolutely. Because Russia obviously commands, approximately 10% of the world's oil production. So there's a lot about macro playing out at the moment. A lot of deals being done behind closed doors, but we put buys on our stocks, our oil stocks, around August 2020. So we got in a bit early. But as you know, if you want to make these returns, you need to be in these stocks before they rise, not after they rise. So got in a bit early, held firm, and we've reaped the rewards. You can clearly see on the charts there, it's just been going up consistently, a bit of volatility in between. But our oil investors are sitting on some pretty handsome profits at the moment. And we expect oil prices to remain high. Our prediction at the end of last year was $110 a barrel, and we've hit that now. So we're holding, and it's all about supply and demand at the moment, and the supply clearly exceeds demand. On top of that, we're in a war there, and it could shoot the lights out from here. So we'll just watch this space. We'll research it closely, and we'll advise accordingly.
Okay, so if you're an investor holding oil stocks at the moment, our general advice is hold. If they're quality companies, hold. If you're looking to get in right now, probably be careful in terms of don't chase the all-time highs. Maybe potentially buy them on the dips is what our general advice would be. Next up is ASX sector weightings. Now, this is another key reason why we're bullish on the ASX market versus the rest of the world this year. If you look at the breakdown, 31% of the ASX 200 is formed by financial stocks. 17%, which is the second highest, is materials. You combine those two together, that's nearly 48, nearly 49%. Let's call it half. Half of our index is between financials and commodities. Now, if the market overall has to go up, well, these two sectors have got to do the bulk of the lifting. Agreed? Now, if they have to lift, and we're going to provide a couple of reasons why we believe both these sectors will lift this year, then the overall market will do much better compared to the rest of the world. Let's have a look at some of the reasons. So today we'll focus a little bit more on the financials and commodities. A lot of sectors are getting rotated, and technology stocks are getting hammered at the moment in particular. So let's have a look at commodities first. Hard commodities. So now, Edward, if you look at hard commodities, for those people who may not be aware, we're looking at the likes of precious metals. You look at iron ore, lithium, nickel, the real hard commodities, and you can look at year-on-year results. Most of them have had a fantastic year so far, but we're in this new super cycle. If you let's look at the first hard commodity, lithium. So Ed, your thoughts on lithium? Is going bananas at the moment?
Look, like any boom in any particular sector, there's always the investors that come in late and push the prices up, and that's what's happened with lithium stocks. It's a bit like what happened with crypto, and then we saw what happened there. Boom turns to bust. But look, the demand is clearly there, and there's some people there that have invested early that have done very well, but there's also some investors, new investors in particular, that have come in quite late and paid much higher prices. Yes, the demand is there. Supply, it's coming, plenty of it. Record levels of exploration in this battery metal sector. So rare earths and the likes. There's plenty of it. It's coming. We're in a super cycle, as you mentioned, Roger. We predicted this back in 2020. We've got key stocks aligned across all those hard commodity products, and we've done very, very well, especially in our mining report. Obviously, we specialize in mining. Back in 2000, we started with a single mining portfolio. It was our preferred portfolio in the market, and eventually we added industrials, and we've been winning right across the board here. This is the best I've ever seen. I've been here for almost 11 years, and I haven't seen a boom like this. And we got in very early in this cycle, and we've got massive profits right across the board. But again, if we believe in the theme, we're going to ride it long. We're not going to be an opportunist and take a short-term profit, because the big money's made by holding stocks, and we'll explain that later.
Yeah, and look, one of the stocks you can see there is Allkem. This is the 5th largest lithium producer in the world. And yeah, that's gone from $2 only a year and a half ago to now $11. So this has been a star performer for us. So I guess the question for you watching the webinar today, in fact, Ed, I can see on my screen, there's about 450 people watching this webinar right now as we speak. So I'm sure there's a lot of people who got into some good quality lithium stocks. The question for you is, if you bought the likes of Allkem or some of the others, okay, great. Do you want more? On the other hand, the other question is, have you missed out on completely on lithium and nickel? Well, if the answer is yes, maybe you are looking for a couple of recommendations. Maybe you want to add something to your portfolio. Look, we can highlight a number of stocks within that space, right from junior explorers to soon to be producers. So we can give you a range. For example, let's look at nickel at the moment. I mean, nickel's another commodity which is skyrocketed, and we've got a number of stocks within nickel. Look, our view is the next 3 to 5 years, this commodity super cycle is here to stay. And we've only had 4 super cycles in the last 100 years. And this is the 5th one. And we flagged that about a year ago. And we're already well into this now. So, for example, if you look at the likes of, this is a stock, look, we can't give the name away of this stock, but this stock has tripled in the last year and a half. It's gone from 74 cents, which was our initial buy, to currently at $2.20. Now they're about to become a producer. So one of the key reasons why the market is loving this company is they've had fantastic drilling announcements, great location, and they're soon to be a producer in the next 3 months. So when they start producing nickel, you're going to see even surging demand from bigger investors and fund managers. And this stock, we believe, is going to go higher. Our members have gone into this stock early, and they're reaping the rewards. So we can give you some of these recommendations, and we'll talk more about it. And finally, copper. That's another commodity which has done extremely well. Have you got something in copper? If yes, you would have seen the rewards. If not, there is a stock coming up shortly that we will give you. Now, this is a list of the top 10 stocks on the ASX 200 over the last financial year. So we've done quite well, because the first, Chalice Mining, third, Hub24, and the 5th, Orocobre, which is now called Allkem, they are fat profits recommendations. So we were able to get first, third, and 5th, 3 out of the top 5 on the ASX 200 list last year. Now that's a pretty solid achievement. I'm sure you would agree. We are proud of that, and we always will be, because it's very hard to achieve it. Even to get 1 out of top 10 is pretty hard to achieve, let alone 3 out of the top 5. So I guess, credit where credit's due. Our team of analysts, they are very popular, and for good reason, because the results are there for everyone to see. Now, if you look at the first stock here, Chalice Mining, it's currently a whole recommendation. We're not giving that as a buy, but they've actually had a phenomenal run. They've got sites in WA, they've got sites in Victoria, nickel, copper, gold. They've had huge discoveries. Their portfolio has been fantastic.
Also palladium, Roger. They've also found palladium, which is very rare. And Chalice is also the biggest gold strike in Australia. Sorry, the biggest strike in general in over 20 years. So that's why that share price is followed. So they're going to be a major open pit, full production producer in years to come. A lot of it has been factored in, but the exploration continues. The ground has been extended, so there's probably going to be some big announcements to come in the months and years to come, which will probably further even expand this company.
Very good. And look, there's been several members, look, without really going into too much detail, but this is a testimonial from a young member. We've got a lot of our semi-retired and retired investors. But this guy, Grant, he's quite young. He's only 33. And he put 5,000 into Chalice at early stage at 12 cents a share in 2019. Then he put another $3,000 at 18 cents. And then he started to see the share price really move. Once it reached $3.50, he put in another $10,000, and he hasn't sold anything. All up, he's put in $18,000 in Chalice. And today, that stock is sitting on $500,000 for Grant. He's only 33 years of age. Look, he's been referred to us through his father-in-law, Ian, and then his uncle, Rod, who's also joined us. We've spoken to all these guys. They're huge advocates for fat profits. And of course, for a young guy, or any guy for that matter, or girl, if you turn 18,000 into $500,000, well, you'll be, of course, very happy. So look, there's a number of stories like that. It's been life-changing for some.
I hear them all the time. But that's just perfect about the accumulation of stocks. You know, if you strongly believe in a particular business, you accumulate your position, you grow your position over time, not take the opportunist quick profit, lock it away, and then move on to the next one. And that's how you get big wins in the market. So we've got plenty of examples of this. It's very exciting to hear these testimonies and stories, especially when they go and post them on review websites themselves, and then we read up on them, and then we can refer them back and look back at it and, you know, clap our hands and say, well, that's another success story.
Correct. Yeah. Excellent. So that's one. But to give you one recommendation, another one today is a company called South32, and most of you would have known this company, but if you don't, well, Ed, maybe we can tell them quickly in 30 to 60 seconds, but this result they've had pretty much speaks volumes for itself, because they're not into just one commodity, they're into pretty much all the commodities.
Multi-commodity producer. Obviously, it's the old spin-off from BHP. We've held it from day one and put multiple buys on this one. Hasn't always done well, but if you're patient and you've got to be in a position before it moves. This is a stock that's doubled in value in the last 2 years, and its advantage has been, you know, rationalizing its costs and expenses in the short term. And then when the super cycle kicked in, they're reaping the rewards, like most of our producers. But because they are multi-commodity, it's in high demand, and that share price, you can see it there, $1.51. Yeah, consistently up and down, up and down. Used to be a really good trader stock, and that sort of fell away over time when the share price dropped back there in 2020. And then since then, you can see the nice rise on the charts. It's been following the super cycle. You know, all their commodities that they produce are increasing in value to spot prices, and the share price just naturally follows. So, and on those pullbacks, there were plenty of opportunities to get in on this stock, but at the moment, it's right up there at the moment. It's starting to look a bit overvalued, but if this super cycle continues, valuation goes out the back door, and this stock could be anything in the future.
Yeah, look, the cash that these companies are churning over is unbelievable. And as Edward said, if the super cycle continues, which we believe it will, then the amount of cash that they're turning over, and just go back to the previous slide, if you see first half 2021 versus first half 2022, it is chalk and cheese. They've turned over 1,800% higher profits versus the year before. If that doesn't convince you that we're in a super cycle, not many things will. And the final point.
At the moment, a lot of balance sheets look exactly like that, where you look at the previous year, and then you look at the current year on the balance sheet. It's phenomenal. I've never seen anything like it before. It's incredible.
Yeah, it's amazing. So I think the question needs to be for the audience of watching it today: did you buy, you know, any of these companies we looked at so far? Or if you're doing your research, which I guess watching this webinar today is part of your research, right? You're looking at, okay, what's out there. Even if you can't handpick a Chalice Mining, you know, which, let's be honest, not many people did other than fat profits, but a South32 or a BHP are not that hard, because they are bigger companies and they're still making a lot of money, right? So you should be able to pick these, and if you haven't, maybe it's time to look at doing something different. Let's give you one more recommendation while we're giving away some recommendations. Now, Whitehaven Coal. Obviously, they're in coal and energy. Coal prices, have a look at the coal prices with no rocket science here. They've been on the way up, right? supply versus demand. You look at a company like Whitehaven Coal, they were in debt a year ago, in debt. Their balance sheets were not the best at all. And look at their recent announcement. They've had a record half, as it says on your screen. Everything's on the way up. Even they've been declared a higher dividend than any other in the past, and a share buyback of $400 million. And what's happening to the share price? Surprise, surprise. The share price has gone up and up and up. In fact, we got in the company at $2.08, and we bought it a couple more times. It's more than doubled. Yep. So this is another example. And Ed, this is a stock we've been giving away as free in these
not everyone's favorite topic, obviously, because of global warming and green energy and all of that. But let's face it, we're investors. We present it as we see it. It's not for everyone, but the investors that did get into this particular commodity, this prediction was based on because we predict the market. We don't deliver the news here. We're not the Financial Review, okay? So we're predicting the market because we predicted that coal and energy demand was going to spike in the year ahead. This stock sat right into our thematic. We only wanted to cover one coal stock. We didn't want to have two coal stocks on the books. We could have easily got into New Hope as well, which has done very well, but we just wanted one to be in line with that thematic, and we wrote it out. You can see the volatility there. It hasn't always been smooth sailing, right? Looked pretty ugly there after that, before that 246 buy. It had a sharp correction on the chart, but we stuck to our thematic. We're not opportunists. We're not day traders, all right? We predict the market. That's our job. That's what we've been doing for 22 years. And this sat well in line with our global thematic on thermal coal and energy prices, okay? And we stuck with it, and now we're reaping the rewards. Are we going to take a profit? We'll soon find out. But because it's in line with our thematic and that thematic continues, members have been asking, well, look, I've doubled my money. Should I take some profits? We'll let you know. It's in line with our thematic. Again, we're not short term, so yeah. we're going to reap the rewards of this one as well.
Sure. And look, this has been a free recommendation. We've actually been giving this away to people who are not even members. In these were free webinars, and I know some people have actually made money off this, which is great. Good on you if you have.
In January, I believe, Rog. Yep, couple of times.
Couple of times actually. So. And look, while we're talking about commodities, so that's hard commodities. So we believe ASX will do well because we've got some excellent hard commodities. But another one is soft commodities. And if you look at agricultural companies and sectors, and you can see the year on year is probably the easiest way to look at the comparison from last year to this year. Everything is in the green, right? And if you look at food inflation, it's pretty obvious when you go to the supermarket and your local groceries, you know that the agricultural prices, commodities have really spiked, fruits and veggies, and that's here to stay for a while. And you also see wheat prices and everything else in line with that. So one of the stocks that we've got a number of stocks within the soft commodities as well, but we're happy to give one of them away today, Ed. So over to you to tell us a bit about Nufarm.
Yeah, absolutely. They're huge in the seed industry, providing seeds globally, technology as well. It was part of our soft commodity thematic where we predicted food shortages and an increase in demand. It's not a stock that's always done well in the past. It has struggled, but again, you need to be in these stocks before they move. So we're in this stock. There's one other that's done very well in our portfolio as well that has just hit record numbers as well. So it's all about forward predictions, right? So that's what we do. We've predicted that this sector will boom. There will be shortages. The seed industry, they are the leading player here in Australia, providing globally and supplying even developing countries as well. But you can see on that chart there, you can clearly see there, that looks like a heart monitor. It's kept somebody alive for a long period of time. But eventually they've come out the other end. Heart transplant, and off they go. So it hasn't always been sailing. It hasn't always been smooth sailing, but again, you need to be in this stock. It needs to be part of your thematic, and if it is, you'll reap the rewards when that thematic starts to play out, and that's exactly what's happening at the moment. Are we going to take a short-term profit? Probably not, because we've been in it for so long, and that theme has only just started to play out. So great result, record result in February, and we're going to continue to ride this one longer. Yep.
Talking about the heart, we've just got a comment come in, Ed, as from Andrew. He says, guys, excellent presentation so far. I agree with your commentary on the ASX and also the backing with some data. But he's talking about New Farm now. He's saying, I wish I had listened to your commentary on New Farm earlier, because he just sold out a couple of months ago. Yeah. And he just a bit of a heartache now looking at the share price. So,
well, we put this one in early Feb, Rog. You know, we talked about the soft commodity, our soft commodity theme in early Feb, and that's before they reported, and the stock was trading under $5. So yeah, it was another free one that we gave out, and then obviously since then they have actually reported, and you see that blue line on the chart, the spike. That's after they reported, and it's been going up since. So a bit of profit taking there, as day traders do, but the value investors stay in and they reap the rewards in the end.
Sure. Excellent. Look, Andrew, sorry to hear you sold out earlier, but look, that's probably one of the reasons why if you join our service, we keep you up to date with these type of stocks and recommendations, because we do these webinars every week for our members, and members certainly stay up to date. Now let's move forward. So how do you make big money in the stock market? I think everyone who's watching the webinar right now, that's probably the number one reason you're watching the webinar, is because you're looking for an edge. You're looking for something which will help you make some money, right? And the one key reason how we make big money is we follow this guy, Warren Buffett, who's arguably the best investor in the world. He's received, or achieved, I should say, over 20% returns per year for the last 40 years in the stock market, which is unmatched to date. So how does he do it? He buys when others are fearful, and he sells when others are greedy. So a bit of a contrarian approach, and we follow his approach. So if you look at him and his business associate, Charlie Munger, on the left, they don't buy and sell stock. They're not traders. And the one thing we at Fat Profits also don't do is trading. We don't buy and sell. We buy and hold for a long period of time. And that's how you create wealth. And I think anyone who's watching it today, if you take one thing away from today's webinar, is trading is one of the hardest things to do in the world. And the quickest way for you to lose money, give yourself a headache or two, and give the ATO a pretty nice tax bill at the end of the financial year, because you're buying and selling under 12 months, you're paying a lot of capital gains tax, not a lot to show for it. So at Fat Profits, one thing we teach our members is patience, because patience is your number one asset as an investor. You hold quality companies, research them well, and you reap the rewards. So who is Fat Profits? Who are we? Edward, over to you. Maybe shed some light a bit on who we are and how we differentiate versus the other.
Yeah, absolutely, Roger. And just on that previous comment, you know, a lot of new members join Fat Profits that have never invested before. And I tell people I speak to all the time, you don't have to buy a single stock, because you need to understand the markets before you invest. And that's why people subscribe to us as a leader in the industry, and we're trusted because we actually have skin in the game. You know, we have 8 managed portfolios, separately managed accounts, SMAs. We have now 4 listed funds, index funds on the ASX, and LIC as well, 2 LICs. So we've got money in the market. We're global. We don't just cover Australia, we cover the US, we cover Europe, we cover UK across our portfolios. So Angus Geddes started this company back in 2000. You know, we reached out in a London office. We've got a wealth management division. We've got an Auckland base as well. We cover emerging markets as well. Most of our investors here in Australia are self-managed super fund trustees. They invest long-term. They're value investors. That's why they follow us. I can pretty much guarantee you that probably 70 or 80% of that self-guided market, long-term investors have at some point subscribed or still subscribe to Fat Profits and have definitely benefited over the years. We're not stockbrokers. We don't do any buying and selling for you. That's been our success. Again, self-guided investors can go and set up their own CommSec or ANZ shared trading or share investing account. You get live data there. So we're not a data service. You won't get any data from us. You only get research and support and predictions, forward predicting. So we don't deliver the news. It's all research. It's all forward prediction. It's all support. It's all about stock picking, and it's about making money at the end of the day. That's why we're in the market. David Lennox there, mining expert for well over 20 years with fat profits. He had humble beginnings with Colonial Mutual Life there, and he's had access there with Suncorp Group as well. He knows about stocks. He knows about mining stocks. That's what he specializes in, but he also researches the macro as well, and he delivers on that with his weekly members webinars. Very popular part of our team, David, very knowledgeable. He's picked winners like Chalice and I've got a few others, but they're all in the portfolio. Yeah. But Orocobre, before it became Allchem, I remember he put out that midweek alert in 2020 at $2. I know I bought it. I filled out a form and I bought it. I've still got it. That's gone to $10. So, wealth management. This is part of what we do. We're not financial planners, but we do have separately managed accounts here at Fat Profits. And a lot of our long-term members, a lot of them that don't want to manage a particular segment in the market, maybe small to mid caps, or maybe an income portfolio, or maybe mining, or perhaps global opportunities. They don't want to buy individual global stocks, but they don't want to get into managed funds or ETFs, would set up a separately managed account, and we'll do all the legwork there. We'll professionally manage it, and obviously they pay a management fee for that. So it's all about spreading your wings wide, not thin. A lot of our investors I've spoken to over the years, they tell me, look, I've got hundreds of thousands, or I've got millions in the market, but I don't want to risk by managing it all. It's too risky. So I need to diversify and move some of that money around, let some other people manage it as well. But I do want to have my finger on the pulse, and I want to manage the bulk of it myself. So our wealth management division there, Roger, you can explain that on the chart. It's very clear, our performance.
Yeah, look, you're right. Thanks, Ed. Yeah, you can see that on the charts. The orange line, that's our Australian portfolio, and the black line, that's the ASX 200 portfolio. So our orange line, which is Australian portfolio, has gone up by 338% since inception, and the ASX 200 in the same time has done 122%. So we nearly tripled the market, and the orange line is firmly going further away from the market. And this is a clear sign that our fund managers and the team are certainly outperforming the market on a regular basis, and we've never been below the black line and consistently moving away from the market, which is a great sign, and that's making a lot of money. Now, finally, we will also, before we look at some other buy stocks, and we're going to give away a couple more today, so hopefully you can make some money off our research. We'll also tell you which stocks to avoid. And here's the first one, Magellan Financial Group, MFG. Now, we're very familiar with this company, by the way, because as you can see on the charts, we bought this stock very early in the piece in 2012 when they were a junior company, really just starting out at $1.74. Not many people had heard of them before their ads started to pop up on TV and they started sponsoring the Ashes and the likes, but that was years later. But we sold this company at $25.82, which at that point in time was a huge gain for us of over 1,600%.
Yeah.
So a 10,000 there would have turned into 160. And look, we walked away with that very happy. Having said that, look, the stock went on. It did go on and hit nearly $70. In hindsight, we could say, look, you made a lot of money, but you missed out probably on some more. But look, there's been a lot happening in this space, Ed. This stock has come tumbling down 14.
Yeah, that's right, Roger. At the end of the day, it's a 10-bagger, and you'd be silly not to take some profits if your stock goes up 10 times. And that's basically what we did. Hit our sell and overvaluation parameters, and then obviously sentiment kicked in, and then it shot up during that boom time there. But look, very clear on this one. We've been avoiding it for a long time now in our members webinars. We've watched it drop from about $25 down to, where is it now? I don't know, around $14.
Yeah.
So yeah, we've been avoiding it for a long time, even on these investor webinars where we show you what we do and how we do it. we've been telling investors to avoid this stock. So, and the whole time it's just been dropping. So the CEO and founder stepped aside. He's got marriage problems. He's now stepped aside as director. They've lost their #1 client, which was 15% of their revenue, and then none of that's going to be replaced anytime soon. So it's still an avoid. That's that particular stock. Yep.
Okay. Next up is Zip. So that's another stock. Look, buy now, pay later. There's been a lot of hype in the market with these companies, but they're yet to turn over a profit. People don't realize that, but speculation has really taken this stock up to $14 at one point. And look, some people must be suffering at the moment. So we apologize if you're holding this stock and you're seeing some red, but we're avoiding that the whole time.
That's right, Roger. We've avoided this stock for well over a year now, and the whole year that we've avoided it, it's just been falling. They're now looking at an acquisition with Sezzle, and they've started to reduce costs overseas. Look, potentially a turnaround story in the future if they can start making some money, but we'll let that all play out in the short term. But the fact that we've been telling our members to avoid the entire buy now, pay later sector, and we've done very well there. It's one of our best calls in the last 2 years. And you know, there's a capital raising there recently that's playing out, and you know, look, yeah, just we like to we invest in companies that are making money, not potentially to make money, and that's the key. That's the key in the market. This is speculative stock, day trader stock, and look at the result. So there you go.
Yeah. All right. Well, thank God we've avoided that. And the last stock we're still avoiding today because we get emails from our members from time to time to say, what do you think about Kogan? What do you think about Zip? They're surely looking cheap now. But look, cheap is easy to look on the chart. It looks cheap when it's falling, but cheap has to be, as Edward said, we need to see an earnings to rise. If earnings don't rise, the share price will not pick up. As simple as that. And the earnings are falling. So Kogan's another one. Yeah, we've avoided.
Sorry, the boom period's over for this stock. During COVID, everyone was at home. They're aggressive in direct marketing on your online. You click on one ad and another one comes out. You know, direct marketing business, basically. Invested a lot in their own products, very cheap and nasty. I've used 1 or 2 and I won't be buying again. And you can clearly see on the charts that it's for speculators now. The balance sheet tells the story, and that boom time is over. They've enjoyed the pandemic time, the stay-at-home time, where people spent a lot of money online. That's all changed. It's all back to fundamentals now. Again, another stock that we've been avoiding for a very long time, and this is the result. So another one that we got right.
Okay, all right, so avoid. Now, let's have a look at the dividends portfolio. So people watching this webinar, there's no doubt there's a few who rely heavily on dividends as part of the income. So for you, we run an income portfolio with Fat Profits website, and it's available to all members who pay for the subscription. And this portfolio has produced fantastic returns. So if you see on the bottom right here, the portfolio has been averaging 18.1% annual returns for the last not 1, 2, or 5 years, for the last 10 years in a row. That's the average. Now, this is phenomenal return, and I have to be honest, we have 22 stocks in this portfolio. Now, we're not showing the names of these stocks on the left because obviously you're not paying for the service just yet. But we've got financial stocks, industrials, and property stocks, a range of top 200 companies. And we've got the prices there on the left. You've got the dates we bought them. We've got the capital return on every stock, and the income return, which is the dividends, and a total return, which is a combination of both. And then you've got the percentage annual returns. Now, the key thing with this portfolio is it's a rather conservative portfolio because most of these companies are in the top 200, and we researched them. We know these companies well. We update this once a quarter. Just once a quarter. You don't have to make a lot of changes and don't have to look at the markets every day, but the result is pleasing because everybody wants to get, you know, if you're getting 7 to 10% a year, you're doing okay. Most people would be reasonably happy with that, especially if you're semi-retired or retired. But ask yourself the question, can I do similar things, take less risk, but if I can achieve 18% a year, including dividends and growth, well, how would that make me feel? And what would that mean for me? Now for you guys, we also have a composition where we break it all down. And look, we're happy to share a couple of examples you can see on the left, so you can get an idea of some of the stocks. And this shows you what percentage dividends we're expecting from this portfolio. So you can see the net yield financial 2021, 2022. You can see the gross yield financial year 21, 22, and the franking credits, which ones are 100% and which ones are not. But Ed, the percentages wise, I mean, we're expecting what, 6% a year in the next financial year in dividends alone?
Yeah, once you add the imputation credits on some of these stocks, 6%. But as you can see, we've got it right because we're well diversified. We didn't just buy the banks, which is what some investors do because they're familiar with them and they know they pay dividends. But we've reaped the rewards of just some of those stocks on the left, like BHP, which paid a whopping dividend recently in US dollars, which was phenomenal. And their shareholders are about to potentially get some rewards from the sale of its petroleum business, but that's yet to be disclosed to the market. So a firm holder of BHP, but just shows you some of the resource stocks now are some of the most cashed up stocks in the market. And we've got a number of them on our books that are paying record amounts of dividends. So it's important to be diversified. And as you can see there, we're well in line with the Australian market: financials, industrials, and property. That's the bulk of the Aussie market. And these are the most profitable companies on the ASX.
Okay, we've got a question just coming from Margaret. She's saying, I'm retired and I rely heavily on dividends from my portfolio and I run my super fund. So her question is, if I join Fat Profits service, will I be able to follow this portfolio? And if I follow this exactly, will I be able to achieve similar results as 18% a year?
Absolutely, calendar year. You need to hold it from the start of the year to the end of the year. You won't get the exact 18 because that's the average, but you will get similar results, right? So 18 is the average per annum over 10 years, but you will get similar results. I know a few members that have bought all 22 stocks or that own all 22, and they follow this absolutely religiously. So they have actually got those returns in their super funds. You'll probably have to need to have a pretty large portfolio to be able to hold all 22 stocks. But this is, again, for a cost of a subscription, you can do this yourself. You can buy all these stocks yourself, hold them yourself, get the returns, and you're not paying a financial planner a management fee, which takes out a big chunk of that, or a stockbroker, a big chunk of those dividends that are going to be coming in, which is one question actually it's something I hear always new members joining. So look, I paid my broker or my planner $8 or $9 or $10 or $15,000 last year, and I performed worse than the market. I mean, how is that even possible? So I can do this myself, and for a cost of a nominal subscription fee, and get these types of returns, and then I've got an extra, $5, $10, possibly $15,000 still in my super fund. And you accumulate that, compound that over time, and you'll see how our members have been benefiting for over 22 years. It's a no-brainer.
Right. And correct. This has been a long time performance. So next sector, just to look at briefly before we give away some more recommendations, financials. Now, briefly touching on it, look, we've seen the US Federal Reserve recently raise interest rates by 0.25%. This is the first time in 3 years. And we're expecting them to raise rates 6 more times this year, probably more aggressively to curb inflation. Why they're doing that? To curb inflation. Now, if you look at the bond yields, the US 10-year bond yields, they have really started to spike because the bonds are going out of favor. People are selling bonds and the bond yields are going up as a result. So if you look at the inflation figures, you can see US inflation is up to 7.9% now, which is the highest it's been on the last 40 years. Everything in the US, from, of course, gas prices to fruits, meat, everything is on the way up. So what are we looking at in Australia? So let's look at 2 stocks. First one is Hub24. This is a financial technology company. It's currently a whole recommendation, but they have a platform. Ed, maybe just very briefly, this company was the 3rd best company on the ASX last year. And there's a couple of reasons why we like them,
Yeah, just the funds under management, $68.3 billion. It's a leader in the industry. It's got the most as far as we know, the most highest demand. I mean, there's a couple of others out there like Net Wealth and the likes, but you know, Hub platform revenue up 76%. Yeah, underlying EBIT 72%, all up. It is going up. This stock and the share price keeps going up. But I have noticed lately the day traders have caught on it. So you can see that chart towards the end. See that volatile chart? It's a very popular day trader stock, right? So it'll go up $1 and down $1 quite regularly. But if you look at the thematic, we got in at around $1. You know, back in 2014, we've been riding it. It's actually a 20 bagger for us off its highs. You can see the highs there, touched $35 recently. Sensational chart, and a big spike in 2020. You can see that there. You had another opportunity there to buy it at around $7, and it shot the lights out there. But the only concern I've got is that it's a bit of a day trader stock at the moment. I don't like to invest, me personally, I don't like to invest in day trader stocks. You see that heart monitor there, it's on life support, but I can guarantee those fund inflows continue and that revenue continues, it'll go back and probably touch those highs at some point in time. But another success story here at Fat Profits, where we can buy a junior, undervalued company, same as Magellan Financial. You know, we bought it as a small cap, and we've been reaping the rewards ever since.
Yep, excellent. So another one, and look, one we can give away as a buy recommendation is NAB. Look, this has been one of the best big four banks. They've actually doubled since the pandemic lows. Recently, they've had the quarterly update, which was highlighting some better earnings. They've improved in the home loan market as well. They've captured a bit more market share, and they've completed a $2.5 billion buyback. And they're also going to announce another somewhere between $2.5 to $3 billion buyback when they announce their half-year earnings in May. So that's not too far away. So we're expecting a good update, solid dividends. And look, if you're holding any of these big four banks, you would have done well. Our view is the banking and the financial sector will benefit from rising interest rates, which we're yet to see in Australia, but they are coming. And if you're holding these stocks, our general advice is continue to hold. What if you're not holding them? Should you be buying them? Yes, you should. We've got a couple of buy recommendations. One of them is NAB, but does that mean you buy any of them? Well, no, you still need to do your research. You need to read the books and the balance sheets. And if you're not able to do that, well, maybe you join a company like Fat Profits. We do that all day long, and we provide the research to you to make it simple. But that's another one on the back of that. Now, finally, we not only tell you when to buy, but we also tell you when to sell these stocks. Here's a list of our recent sell recommendations. Some of them are half sells. So you see Boral at the top. We bought it at $4, sold at $7.41. That was a half sell, and we've locked in a pretty decent gain, and the list goes on. Recently, we've also sold half of ARB, and that was a quite nice one, and also Amcor, the packaging company. But look, did we get all of them right? No. You can see a couple of reds. We got, Decmil Group and Saver Limited. So those two were losses, but most of them are in the green, and we're very open about it. Everything is on our website, and you can see it.
So, yeah, Roger, Domain was a classic. We've recently had another new play on that stock, but we did take a sell half at well above $5. And that's been a recent play that's played out as well that our members are enjoying. So that's a pretty good one as well. Domino's was great as well, about 110. So the timing was right. We didn't get them all right. You know, some of these small caps like Saver and Decmil haven't been success stories for us, unfortunately, but generally they're smaller companies. We'll put them in there to add a bit of variety, but we got out of China, Platinum Asia, actually. The timing was impeccable out of that particular index fund. So that was great.
Yeah, excellent. So let's have a look at our performance now. Before we look at a couple more hot buy recommendations, so we are going to give one away towards the end. But before we look at that, let's have a look at our Fat Profits results. Now, this is where I think a lot of people start to look at us in detail, and I think you'll probably pay a bit more attention at this point in time. You look at our annual return since inception, which is 2000. We've been averaging 17.8%. Let's call it 18% just for the sake of it. 18% returns per year for the last 21 years in the stock market. versus the ASX, which has done 8.5%. So we've been outperforming the market by over 9% per year. So I suppose the first question here for you is, how are your results compared to this? Are you getting 7 to 10% a year? If yes, okay, you're in line with the market, so that's fine. If you look at the breakdown, and we break it all down on our website per year, so you can see in 2020, we've done 20% returns versus the market, which did 3.6%, so we had a good year. But look, we're not perfect. In 2019, we actually underperformed the market. The market did 24%, we did 19%. So you can say that we could have done better and should have, and we didn't. But in 2018, we actually had a pretty good year. The markets were down, and we outperformed the market in double digits. 2017, we doubled the market. 2016, we doubled the market. And in my view, 2015 was our best year, where the markets were down by 3.5%, and our portfolio completely reversed and was up 18%. Now that's to date at our best result, which outperformed the market by 21%. So all in all, look, we get it right more often than not. Do we get it right every single time? No, look, we don't have a crystal ball, but we are very good at what we do. Are we proud of our results? Absolutely. Do we publish these results online? Absolutely. You can see them yourself on our public page. Are they all audited? Absolutely. We're regulated by ASX. These are very proud results, and we're open about it. Now, how would that look like for you if you were to maintain these results consistently for 5, 10, 15, 20 years? What would that look like in dollar terms? Now, for somebody who's not very good at maths, here's a quick chart. So if you had invested $10,000 back in 2000 and followed our recommendations and got a 17.8% return, and all you did was top up year on year by $5,000, just $5,000, you add that from one year to the next, what would that look like today? It would look like $1.6 million 20 years later. Now, I know that's life-changing for some people. It's, of course, substantial for a lot of people. Now, the reason we're demonstrating that is the power of compounding returns. We're not saying that you would have done that exact same thing for 20 years. It's pretty hard to follow every one of our recommendations, let's be honest. But if you had achieved good results consistently for a long time, that's what we're trying to show you. That
Yes.
would mean a lot, right? Now, Ed, just have a look at, let's have a look at a few reviews, because obviously it's not just us telling the audience today, but it's also a lot of our existing paying members with real money in the market.
Yeah, we took these off product review. These are actual reviews. I review products all the time on Google, mainly Google Maps, places I've visited, you know, especially restaurants. I love reviewing restaurants. But these are actual members that have joined us. Some of these members have been with us for a long time, some for a very short time. I've noticed a lot of short-term reviews, people that I didn't notice on there, people that have just joined. We had a guy that just bought one of our smaller mining stocks off a hidden gem, actually, a couple of months ago, Rog. He put probably way too much money for a small cap. I couldn't believe the amount of money he put on
300,000.
Yeah, it was something like that. It was ridiculous. How much did he make in a week? Like 60,000 or something? Anyway,
60 grand in a week, yeah.
And he was gloating about it. He put it everywhere. And I said, well, gee, I wish every single recommendation was like that. But he probably put way too much money on that stock. But anyway, he took the risk and got the reward. So, and he's been recommending all his friends, colleagues, families to join. It's a very quick way to make money, he's saying. But funny enough, that particular stock has kept going up. So his profit at the moment is going to be huge, phenomenal, because obviously we haven't sold out of that stock. But these are actual reviews, you know, people sharing their experience with Fat Profits. Enjoy the service. They've done very well out of it. Again, all it cost them was a subscription fee, and that they build up their own knowledge, educated themselves, confident in what they're doing, just simply by following our value investing approach and the stocks that we recommend as well, our preferred stocks in the market. Now, Roger will show you our members area, a snapshot quickly. This is what members receive when they log into their members portal.
Absolutely. So once you remember, this is how our website looks like. So I've obviously logged in as me. You've got the members homepage, and all you do is scroll down There is a video here which shows you a bit of an introduction on how the members website looks like, but we've got 4 products. So we've got Australasian equities, you've got UK equities, we've got global equities, and we have global mining. And we'll just show you the difference between these 4. So our main product is the Australasian equities. This covers Australia, a little bit of Asia, and a little bit of New Zealand. But the majority is Australia. And here we cover a weekly report. You get buy, hold, and sell recommendations every week. In the Australian market, you get all the new recommendations in a table here. You can read probably the latest 20, 25 recommendations. That you will see them here. You can see our Fat Profits portfolio, how it looks like. You can see all of our past recommendations, all our winners and losers, bit like what we showed you just earlier. You will also get alerted if there is a recommendation, good or bad, and we will alert you via email middle of the day. And that income portfolio that we just looked at earlier, which is producing 18.1% annual returns out of 22 stocks, that's here, and we update that quarterly. And also all of our weekly webinars, which are recorded, and you can replay them through here. So all this is available for our members for Australasian report. Then you also have a mining report, and this mining report is perfect for people looking for the super cycle, junior miners to mid cap. Of course, you've got producers at the top as well. So you've got plenty of mining recommendations. You've got a UK report, which is obviously for the UK market, and the global equities report, which covers the rest of the world, from US to Asia to Europe. So that's all covered. So these are the 4 products we have. Now, just to come back to what this actually looks like. So first thing first, if you look at our performance, of course, our performance is sort of unmatched, other than Warren Buffett, who's done over 20% a year. We're 18% a year. We've been doing it for nearly 22 years now. So it's long enough for most people to say, this is good enough. And of course, we have a good management, lots of experience. So what we're offering you here today is we've got 3 types of memberships. We've got standard, premium, and platinum. Now, regardless, and we have a special offer today, which we'll come to in just a second. Now, regardless of which one you take, they are tax deductible. We will provide an invoice to your self-managed super fund or your own personal name, whatever you prefer. Obviously, we can't give you tax advice, but most of these are tax deductible. We can speak to your accountant about it. Now, to highlight the difference between the 3 memberships, the standard membership comes with a daily Fat Chat market commentary, which is a morning email from our CEO straight into your inbox every morning before the market opens. It covers what's happened in the markets overnight, has a few ideas and recommendations, and it will put you in the picture. Second benefit is you get a weekly members only webinar. This webinar is every Thursday, live at 12 p.m. for 1 hour. Now, if you can make it live, it'll be great, because you can ask questions from our panel about stocks as well as the market. If you miss it, you can replay the recording later on, not a problem. Number 3, you get a Friday Fat Wrap. Now, it's not a kebab wrap that you get every Friday night, so people get confused. It's a wrap up of the week. So any highlights you might have missed out in the week, we will highlight that for you on Friday. So those 3 benefits are across board in any membership. The difference between the 3, with standard membership, you can pick any one out of the 4 reports that we looked at earlier. So you can pick the Australian report or the mining report or the 2 international reports, any one of those 4. Premium is the most popular, where you can pick any 2 out of the 4, and you also get a premium account manager, someone you can speak to, like an Edward Allen. He's a senior, so you'll be lucky if you got Edward, but you will have an account manager, right?
Yeah,
so
I can look after you.
And look, the final benefit is platinum. This membership, you will have access to all the 4 reports as well as the account manager. So most people, if you're an Australian investor only, you'd go for the premium and you will have Australian equities and mining. If you're an international investor or want to be one, you'd go for the platinum. Now, just to explain that further, I've got Edward here, but just before I pass it on to Ed, let's look at the prices, because on our website, I'm happy to show the website price, then I'll pass you on to you, because people want to know what the prices are, right? So if you jump on our website, guys, you will see the difference. You've got the standard membership, premium and platinum. These are retail prices, and you can pay these prices on our website at any time. So standard, you got 1 year and 2 years. Premium, you got 1 year and 2 years, and you got platinum. Right, now keep an eye on these 2-year deals for premium and platinum. See the 2-year deal for premium, which is $27.95, and we've got platinum, which is $46.95. Just keep that in mind, and I'm going to pass it on to Edward to explain the special offers today.
And most new members join on the website. You know, that's the whole idea of putting this investor update here, is to explain our service, show you who we are, what we do, our investment strategy, and how you can benefit. But a lot of our new, because we are global, obviously, so a lot of new members join on the website and they sign up to their preferred service, and off they go. They get their username, which is their email address, and they get a password, and off they go. The advantage of joining here today is that we have account managers here. We have real people on the floor. We're not a direct marketing business. You don't click on one cheap subscription. We know who's out there, and then all of a sudden they get another long-winded email, and then there's another subscription waiting for you. Before you know, you've joined 6 or 7 subscriptions to one product before you realize you've done the wrong thing. So one service here, it's pretty straightforward. It's been the same service we've been offering for the last 22 years, and we've just been improving it along the way. No stockbroker service here, no buying and selling through us. And it's the account management service. Not only our track record of performance, but the ability to speak to someone, to ask questions to your own account manager has been a huge part of our success. You know, as I said earlier, I've been here for 11 years. I've just crossed over 11 years. I wouldn't want to be anywhere else. I've educated myself. I invest. I manage my own super fund as well. So I'm benefiting, but I'm also helping self-guided investors like most of you today, or all of you today, you know, helping you, giving you the information and support you need. Okay, if you want to jump on board and join for standard, we've dropped the price there, $300, $895. So you would pay $1,095 on the website. You're welcome to join and take that up and see what we do and how you would have benefited in the past, and obviously how you would benefit moving forward, because that's really what it's all about. The second one is the premium membership, which retails for $15.45 a year on the website. So we're happy to offer that today for $11.45 a year, inclusive. That's inclusive of GST. If you're savvy and you're confident and you're going to be in the market longer term, we'd highly recommend the 2, and particularly the 4-year offer, which has the lowest annualized rate of $699 a year. So it's $2,795. The last couple of webinars that we've done, we don't normally show the pricing, but this is a great time to join us. So we've actually going to put it in there, and we're going to show you the benefits of membership and also the savings of joining today. So we will put the prices in there. So it's 2 years for $17.95 and 4 years, which is the best value, for $2,795 inclusive.
This 4 years, sorry Ed,
yep.
But this 4 years, so just to remind people, that's our 2-year rate on the website, $27.95. Right. So we're actually giving a 50% discount on a 4-year deal. You're paying for 2 years, we're getting 4 years, right?
4 years for the price of 2. Now, with the platinum membership, a lot of our members manage self-managed super funds. So you would know recently that inflows for ETFs have dropped substantially. So obviously there was that boom period between 2020 and the start of 2022. That's now ended. Money's coming out of those ETFs and they're moving back into equities. In particular, we've seen, because the US market's corrected, and we've seen in the UK, the FTSE is actually performing quite well. A lot of that managed fund and ETF money has moved into individual stocks, and you would have seen recently in the Asian markets, stocks that we hold in our global opportunities like Tencent and Alibaba jumped 34% in one day. Now, if you want to get those benefits in your super fund, you need to spread your wings wide, not thin. Again, it's not for everyone, but education first, investing follows. But the Platinum membership will give you access to our global equities portfolio and also our UK portfolio, which covers the US, Asia, and Europe, including the UK. And if you've got a larger fund, again, if you spread your wings wide, like most of our members do, is you should diversify and put a couple of those key stocks in your portfolio and spread your wings a bit wider, so you're not missing out on markets that are outperforming. And the Asian market recently looks very attractive, so does the US. So that's the Platinum membership, very popular with our long-term subscribers. So when they renew, they always renew Platinum. Most of them renew Platinum, unless they've got their head in the sand and they're sticking on income. Then obviously they'll stick to the premium membership.
Okay, so
mining has been booming, so I'd recommend that report as well.
So Ed, just to clarify, so I'm getting a lot of questions here on my screen. So I'm going to put up a multiple choice question for you guys shortly. But just to clarify, the Platinum membership for 4 years, that's the same as the 2-year deal on the website. So we're giving 50% on that. And the premium 4 years is also the same as the 2-year deal on the website. So if they take those two, they're the most preferred options. But I'm going to put up a question here, and this is a multiple choice question, which is on your screen now. And while I'm getting you guys to make your selection on which one appeals to you, whether you want to go for standard or premium or platinum, one question which has just popped up is somebody said, I recently heard about a portfolio review, which a friend of mine was able to get in the last discounted offer we had. Are we offering anything along those lines today?
Look, we can offer it. Look, if you commit to us for 4 years, click the premium or the platinum, and we'll offer you a portfolio review. We have to put it on your invoice. We will offer you a portfolio review. It's been very popular recently. Like I said, we promoted it last time, and I had to do a lot of reviews, which is fine, but we do have to put it on the invoice. It's a one-off portfolio review, which is done at the time of joining. From time to time, we offer it to our members, our long-term members as well. But when they request it, upon renewal, we put it in writing on the invoice. We just have to have it in writing there to say that you've accepted it. You send in your portfolio via email. We'll lock in a day and time, and we'll do a review. So just note that this poll is not a survey. It's for members that are genuinely interested in discussing our service further or picking one of those membership offers, standard, premium, or platinum. Again, it's not a survey. So yeah, we'll be happy to help. The best way to join is when we offer these discounts, because you'll save money and you'll benefit from our current positions in the market straight away, and we'll show you how we've been helping members grow their portfolios over a very long period of time.
All right. I'm getting a few comments now. In fact, I'm just looking at the screen. Nearly 55% of people have selected on premium so far, so that seems to be quite popular, but I'm getting about 30% roughly, but it's changing every second, ticking on platinum as well. Seems like there are a few people wanting to branch out overseas because the price difference is not a lot. But look, just to summarize it again, the 4-year deal only works out to be $699 per year, so under $700 a year, and that's a great price.
Yes.
And the platinum deal for 4 years works out to be $1,179 a year for 4 years, and it is also an amazing price. So both are very popular, so not a problem. And with the 4 years, we're offering an annual portfolio review. So do take advantage of the 4 years. That's what our recommendation is, and we're happy to look after you. Now, I'm getting a few comments. I'll just read a couple just quickly, Ed.
Yep.
One's just come from Jonathan. He's saying, I'm an ex-member of yours, and I used to be with you for years. Then I had to get out of the market for personal reasons. I'm looking to get back in, and I'm interested in joining. I've really enjoyed seeing your results, and I'm actually convinced that medium to long term is the way to go, and I don't want to do any more trading. Looking forward to speaking to you. So Jonathan, thank you for that. We will help you, and yes, short-term trading is not what we do. We are going to help you with medium to long-term strategy. Another comment just come from Anna. She's saying, I've heard from my friends about you, hence I joined today's webinar. I wasn't sure what to expect, but now I'm actually very clear. Thank you for the clarity, and I'm interested in joining the premium service for 2 or 4 years. Please speak to me and we can work it out. Thank you for that. And look, lots of other comments about the webinar today. Seems like, look, people are making up their mind as they're going along. So we appreciate that. Ed, any comments from you so far?
Happy to take any questions. If you'd like to discuss it further, click that option. We're happy to answer your questions over the phone. But again, if you join the premium or platinum, you'll get an account manager here. They'll answer your questions throughout the year. We all have an email address. We all have a phone number. We're here to help. That's what differentiates us from direct marketing businesses, which this industry is flooded with. We're a genuine service. We've got results. We get externally audited. The results are there. They're in black and white. You'll see them on the website when you log in. You can see the dates and the research when we initially recommended every stock and every recommendation afterwards. So looking forward to welcoming new members. That's why we put on these webinars. I see people here that have been on database since 2005, Roger, 2004, 2009, never joined. A lot of ex-members here, heaps of ex-members. So a lot of ex-members came on board recently with our previous webinars. They've used the service, but they were out of the market for certain reasons, due to COVID or any other reason, family issues or developments, and now they're ready to come back in. So they're coming back in on some of these offers. Quite a few clicks on that premium platinum membership.
Right.
So
Great. And look, just to finish off, for those of you joining us today, we've got a hidden gem which we are going to give you today once we speak to you. This stock is an absolute gold mine, and when I say gold mine, they're literally into gold mining. So this company is about to become a gold producer in the next 3 months. So their production is very, very soon. You can see the brand new mine site with the tennis court there and all sorts of things. They're going to be one of the top 10 gold mining deposits in Australia. You can see the red circle. That's where the company is. We're obviously hiding the name, but they're similar size to West Gold, a little bit smaller than Gold Road and some of the others. So currently, everything is on track. They're fully funded. The share price is actually moving north. You can see in some of the pictures which have come out from the company, they're ready to rock and roll in 3 months from today. And you can see the timeline. They're ready to produce the gold right at the bottom. You can see the June quarter of this year. And if you look at the share price, what it's done, you can clearly see the share price has gone up from 16 cents in March last year to a high of 40 cents recently, currently around 37 cents. So more than doubled on higher volumes. So a lot of our members have made some serious money, easily paid off with a subscription in just one stock. And this stock, we think, even from today, if you bought them today at 38 or 40 cents, you hold it for the next 2 to 3 years, we think this is going to go well and truly north of $1 to $2. And this is something, ask us today when we speak to you, and we're happy to provide that recommendation.
Yep. Yes, Roger, just to note, it's infrastructure ready and inflation hedged. What that means is that they don't have to drill a hole today. The infrastructure is mostly set up now, so they've already paid for it. As we know, everything's going up in price. So any explorer in WA in particular that needs to build infrastructure now is probably going to pay double what this particular company has paid. So that's one of our biggest themes in our mining report, is that we are covering stocks that are infrastructure ready, inflation hedged, producing or going to produce, making money. Right, so I haven't met a single member that have lost money on this particular stock. They've all made money, and a lot of those gains have been substantial. So these hidden gems, we haven't got one wrong yet. I've only been doing this since the start of this year, helping you out, Roger. And every single hidden gem put up there has made money. So everyone that's bought the subscription on that hidden gem has covered the cost of their subscription, and has probably made quite a bit of money on quite a number of other stocks in our portfolio.
Absolutely. This will pay it off very quickly. Thank you, Ed. All right, well, look, that brings us to the end of today's webinar. I hope we enjoyed our company today and got some good quality information. If you have any further questions, you can call us on the 1300 number on your screen. You can also email us at info@fatprofits.com.au. You can ask for Roger, I am the manager, or you can ask for Edward. who's the Senior Account Manager, and we'll be happy to answer any further questions you've got. And look, that's all we have time for today, and we look forward to welcoming any new members to join our service. And for the others, if we haven't been able to convince you, well, look, we wish you all the best. Hope you got some free information. And look, free information can only take you so far, but we're happy to provide as much as we can. And on that note, I'll pass it on to Edward for his final words.
Absolutely. Thank you for joining us today. We wish you all the best with your investment decisions and your investing and your portfolios. We wish you well. If you join our service today or any other day, we'll help you, we'll guide you through it. You can only benefit. That's a key with our service. You will only benefit from using our service. It'll only enhance your current skills and future skills, and it'll make you a more savvy, confident investor. So good luck with that. Have a great day, and hopefully we'll see you again.
Okay, thank you. Bye for now.
Bye.